Good morning, everybody. My name is Jim Cagnina with NinjaTrader. You are at See the Futures. Appreciate everybody being here today. We have a lot of stuff to talk about. Before we go forward, though, let me remind everybody, trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a large combination of leverage and volatility. And although that could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I can afford to lose, doesn't change my lifestyle, doesn't lengthen my retirement horizon, and doesn't overly stress me out. Stress is a big deal. We're human beings. We don't make good decisions when we're under stress. Also, micros are your friends. Easy on the day trade margins. There's a lot of asset classes, a lot of opportunities here. So just kind of slow your roll and be careful and be patient as you are exploring these great CME Group asset classes. Any questions on that, type them in. But really, the main event here, we have Bobby Iaccino with us today, and I'm so excited because we have a big event day talking about CPI and its impacts. It's already been outstanding this morning. Good morning, Bob. How are you?
Good, Jim. How are you, man? I'm happy to be here on this. I like these kinds of shows because it's not only the event itself, but the movement we've seen after the event. I think a lot of people sort of look at it and think what's going on. And it's kind of one of my favorite things to talk about is the reaction versus what the event actually showed us.
Yeah, and it's there's so much anticipation. I mean, you even saw it in the E-mini S&P this morning, where 5 or 6 seconds before the number came out, even there was a huge spike, a huge green rally, right? For no reason other than anticipation, and then boom, the number comes out, and 110 handles later, we're at S2.
Yeah, it was funny. It was the same thing in the yield market. So I mark my yields every morning, first thing when I wake up, and then a little bit later before I send out the your need to know thing that I do for the CME Group on Twitter. So prior to the CPI number, the 10-year yield was 295, post CPI 305. The 2s, 10s yield spread, which we can talk about, which has been inverted now for a few days, was -6, and then it jumped to -14. So big moves in the yield markets as well.
Yeah, no, I noticed that. We've been talking about the 2-year versus the 10-year for a while now, and it just seems so extreme.
Yeah, it's funny because so the level that the 2s, 10s inversion, for those of you guys that don't know what an inversion is, every bond has a yield to it, right? So when the 2-year yield is higher than the 5-year yield, that's called an inverted yield curve, or when the 2-year is higher than the 10 or higher than the 30. When a short dated maturity, 2-year maturity versus say a 10-year maturity, when the short dated maturity is higher than the longer dated, that's an inverted yield curve. So when we hit the inverted yield curve today, we hit the largest inversion since 2007. We all remember what happened 2008, 2009. Not saying that's going to happen again, just saying that's kind of the type of thing that we look at the 2s, 10s, for example, as a prelude of. But when we see these kinds of moves in the yield curve, it's telling you the market's opinion of what is happening. And the 5s, 10s, for example, has been inverted now, if you count today, for 21 of the last 23 sessions. The 2s, 10s has been inverted for 6 sessions in a row. April 1st, the 2s, 10s closed at a -6 basis points. The next day was -1, then it went positive again. This time 6 days in a row. So it's very much about the sustainability of a move and not just a flash move. That's not what indicates a recession. That's why when we're calling for one in April, we are now.
So now is the 2-year more sensitive to pending Fed action than perhaps some of the longer term?
Yes, it is. And it's interesting you mentioned that because something else is obviously very sensitive to Fed action is the 3-month. And since June 14th, the yield on the 3-month rose 42 basis points. That's massive for a 3-month duration bill, right? Treasury bill. It's only 3 months. So for the yield to move that much, somebody literally who bought it in June, I'm going to get almost 0.5% more in yield than the person who bought it in early June if I were to buy it now. That's a massive, massive move.
Yeah, it's amazing. And, you know, the CPI number that just came out, it's been so heavily anticipated. As a matter of fact, there was press releases issued yesterday saying, hey, there's a fake report floating around, ignore it. I mean, everyone's on their toes here with this number.
Yeah, this number was a big deal for a number of reasons. It might actually represent peak inflation on a year-over-year basis. Now, what do I mean by that? Well, let me rephrase that. Does peak inflation actually matter? So the markets were looking for 8.8, and we got 9.1 on the headline year over year. On the core, we got 5.7. I think the market was looking for 5.5. But then the month over month number surprised to the upside as well. So that means that a year from now, you can't get a really good year over year number because the monthly one was strong too. So if you think about just what year over year means, people don't realize that CPI is an index, okay, similar to the S&P. And if you look on your list of the figures that were released today, one of the things that actually got released was the CPI index. And it came out over 296, okay? Post-pandemic on the lows, it's about 259 or so. So that's the index. And those percentages that we look at every single month when the CPI comes out is the change in that index. So year over year, that index rose 9.1%. So I went back and I looked at it in the time between the number and the show, and I realized that from the post-pandemic lows of the CPI index, we're now up 15.77% on the inflation index. To give you some context, from February 2016 to February 2020, so 4 years, was only up 9.1%. Prices are always rising, okay? And I shouldn't actually say always, but if you look at the CPI index, it's just this. Every once in a while, there's a little dip like in the pandemic, but just like the Dow Jones, if you go back to like 1926, it's basically always going up. CPI is always going up. But this is so a 4 year period, it was 9.1%. A 2 year period, a little over 2 years, it was 15.7%. You could basically say that prices are rising at somewhere between 3 times and 4 times the normal rate. That's a really uncomfortable thing for consumers. And it's not the kind of thing that even if the numbers start to flatten out, okay, meaning let's say 4 or 5 months from now, year over year CPI is 3%. We're still above the 259 low that we saw in May of, or post-pandemic, I should say. We're still above that, and we stay above that. So in other words, prices that have gone from here to here rapidly in that little gap, even if they stay here, they're still way higher than they were down here, right? So it's a very uncomfortable thing when they go up this fast for consumers. Real wages right now, Jim, down 4.4%, according to Bloomberg, year over year.
Right. So that means, if you're, I'm just rounding off the numbers. If you're making $100, your purchasing power is $96, $95 instead.
Yeah, you're now $95.60 when you used to have 100.
Yeah, and that's a real issue for sure. I mean, that affects everybody, no matter what.
It does. And if I could go further into the weeds, the kind of things, so used car prices and new car prices kind of stabilized a little bit, right? That was one of the things people were looking at. Crude oil, you see a crude oil chart there on the bottom, right? Here, I'll measure it really quick over here, but crude oil, since the highs, I'm not even talking about those 130.40 highs. I'm talking about since the June 2nd highs, dropped to about 22.6%, right? From those June highs. So we're down in crude oil. Copper, as of yesterday, I know copper, if you look at a daily chart of copper, was down 37% from the highs that kind of correlate to those crude oil highs, okay, right around where your cursor just was. From them, those March highs, we're down about 37% in copper. Okay, so commodities are falling. We're seeing the same types of things in lumber. We're seeing them in some of the ag markets. And what do we get? We get a 9.1% number on CPI. So you could say, well, that's the June number. The commodities just started falling. Well, I mean, did they? You look at March to June and copper fell, right? Maybe not as much as it has now. So what I mean by going into the weeds, Jim, is when you look at, say, page 2 of the CPI report, okay, because I try to look at every little section of the CPI and see if I can find any sort of patterns. You go to page 2 of the CPI report, rent equivalents and home ownership costs are up. They're up about 7%. So shelter year on year is up about 30%. You can't really substitute shelter. Okay, rents are not going down yet. And the cost to own a home, not the cost to buy it or mortgage it, but the costs involved in it are up about 6%. Then I looked at medical insurance, 17.3%. It's up. So what, the old saying is that if beef goes up, you buy chicken, right? Carrots go up, you buy celery. What do you do in place of medical insurance? You buy medical insurance. Now, I know we don't have a Q&A session set up, Jimmy, but if I said, raise your hand if you think the health insurance is going to give that 17.3% back when prices abate, how many people would raise their hand?
No,
I mean, I hate to laugh because it's not a funny thing, right?
Yeah. No, it is brutal.
17%. That's permanent and you can't substitute it. Neither can the corporations that are paying those healthcare costs along with the individuals. Yeah,
and it's very important to most people, right? That's very important. On the housing front, I'm feeling it personally, right? I have two kids in college, right? And they're living, they're doing their thing. And, these college kids don't want to stay in the dorm past their freshman year. They want to go to an apartment with their friends. And so, who's footing the bill? Well, me. But so I'm feeling it, right? Every year I need a little more, I need a little more, I need a little more. And my response is, work a little more hours at the store. Get it yourself. But no, I feel it too. It's a real thing.
Yeah. I mean, if you look at sort of the rent and home ownership costs on the whole in the CPI report, it's down a little bit, but that's only because travel costs have started to slow down. Hotels have gone down. But when you look at rental and home ownership costs, those have gone up. So I actually had somebody try to correct me on Twitter, and I said, subtract the drop in hotels. And this was in direct message. I said, if you subtract the drop in the hotel prices, you'll see that rent and home ownership costs are still up 0.6. So these are pretty big. And this puts the Federal Reserve in a position to, I don't know where it is now, but I like to look at that CME Fed Watch tool.
Yeah.
The CME Fed Watch tool, last I looked, now has 100 basis points, over 41% possibility of 100 basis points at the next meeting.
Bobby, it's 51.1% right now.
Oh, it was like 42 when I last looked at it.
Yeah.
Now 100 basis points.
Yeah.
So
when's the last time that happened? 81?
I don't remember.
Ever?
I don't remember it. I've been doing this 29 years. I don't remember it. So what's going to happen with the Fed, Jimmy? Are we looking at a Fed that's now going to say, we're just going to do 100, 75, 50 and see what happens? I was talking to somebody yesterday and they said, well, what's going to base the markets? What's going to help us put in a bottom in the equity markets? And I said this on another show earlier, but I can go into it in more detail here. Equities have a natural upward bias. There's a certain amount of money that goes into US equities every single month without fail. It's long-only mutual funds, IRAs, 401ks, retirement accounts for people under, say, 55, just going right, especially with yields where they have been. It's probably less strong than it has been over the past 10 years now because yields have gone up a little bit. But the 60-40 portfolio, meaning 60% stocks, 40% bonds, had kind of died, and it had gone about 90% stocks over the last decade or so. So that might have changed a little bit, but stocks have a natural upward bias. They don't go down unless they have news that sends them down. Without news, stocks rally, right? Well, we just got news, right? Now, from a price action perspective, we look at that top left chart, it's holding in pretty well, right? If you sort of look at where the equities are holding in, you're kind of talking about that last batch of lows there that you see on the chart, right around, say, June 30th July 1st, July 5th, that little area right there. I think you're definitely seeing stocks hold in on those lows. I would worry about a break below those lows, especially if we got a break below those lows with volume. We recently had our rotation zone, which you could see right there. I should go over this in greater detail. If you look, Jim, at about, let's say about June 6th, if you can put your crosshairs right about there. Okay, sure. Right around June 6th, you'll see that our rotation zone, which again, for those of you that are just watching now, is the 8 exponential moving average and the 21 exponential moving average, crossed up. We don't trade the crosses. Okay, always got to throw that in. Then you look over to the right, about June 15th or so, they crossed back down. Okay. That's a double cross, funny as that sounds. Now, if you could change this to a weekly, is that easy for you to do?
Easy for me to do. It's just a matter of how long it takes the data to get in. That's all.
Okay.
Oh, no, there we go.
We're good. Look at a weekly and you go to what would be about June 15th or so. Okay. And you'll notice that between sort of June 6th and June 13th, we kind of came up against the weekly rotation zone and failed. So higher time frames matter more than lower time frames. They're more reliable, but you get fewer triggers, right? Just because of the time frame of them. So now if you could bring that back to a daily, sorry about that. Sorry.
No worries. No worries.
It's easy like that.
It's easy. It's easy with the NinjaTrader software. I'll throw that in.
Yeah, that's software definitely is killer. So now you go and you look what happened after that cross. We had an extended move down right after that double cross. We had an extended move down, and now the rotation zone is flattened out. So I have no real signal here. Somebody said to me, I should rephrase this. Somebody said to me, you have to pick. Okay, you have to pick. You're going to pick up or down. I would pick down for the ES. But the fact that it's holding in with this inflation figure is probably due to the fact that earnings start tomorrow. Now we've got bank earnings tomorrow. A couple of things about bank earnings because the S&P will be deeply affected by that, right? Bank earnings may come out strong, but one of the things that I saw yesterday was that we have the highest level of provisions for loan losses being put aside by banks since the third quarter of 2020. So there's probably 3 ways we can look at that. When a bank puts aside money for loan losses, it comes out of earnings. So they might miss on earnings if that's the case, but the money's not really lost. Okay, it's sort of like an escrow, or it's in the mattress to shore up the balance sheet for potential loan losses. So you look at them and say, well, yeah, they missed, but what was their provision for loan losses? And if it's a really big number, well, they didn't really miss. But the second part of that is, why are they putting so much money away? A few weeks back, Jamie Dimon had a really negative comment, a really negative talk about the economy. And I said to a friend of mine, well, I don't think Jamie Dimon is a better economist than the rest of us. And he goes, no, he's not. But JP Morgan will act the way Jamie Dimon thinks. So in other words, if Jamie Dimon says the economy's bad, is JP Morgan going to rush out there with borderline loans? Probably not. Right? The CEO and the Jesus Christ of JP Morgan, pardon my language, is saying that, the economy's in bad shape. So you guys should kind of tighten it up a little bit.
Yeah. And I always felt that, I don't know, maybe I'm wrong, but I always felt that his comments were designed to be biased to the downside, because if that wasn't the case, you're going to look good, right? You did well, JP Morgan. But if you don't do well, he's going to say, I told you so. This is how we're positioning ourselves. So sometimes those comments, I'm a little bit worried about their, just purely factual basis of them.
So here's how I know you've been doing this for a long, long time. That comment right there. Because 87% is the 5-year average of companies beating earnings expectations in the US. That's the 5-year average. Okay, the US companies have gotten really good at lowering the bar and then jumping over a lowered bar. So that's what they do all the time.
Yeah.
My worry about the thing I just said is why are they putting so much money away? 6.1 billion in the banking sector right now. In 2020, they put away 7.2. And it's been increasing since about 2022.
So should we read into this idea that if it's an accurate idea, that car for repos are on the move?
Yeah.
I mean, yeah, again, I don't have any statistics like that off the top
Well,
of my head.
no. So, okay. So I'm sorry. I thought there was more of a question that was your question. The answer is yes. The repos is a big part of it, right? Auto loans. I mean, there's not many auto loans funded by JP Morgan or Goldman or Citi anymore, but it's a general loan environment, right? When you look at, I should say, when we've looked at the savings rate in the US, right? The savings rate is starting to fall, but the amount of savings that is in consumers' bank accounts now is still at very high levels. And stop me if we talked about this a lot before. I do a lot of these talks, so I'm not sure where I've talked about this, but generally, if you were to say that there's this much money in consumer savings accounts, right? And this bottom half represents the lower end of the socioeconomic stratosphere, right? This is gone now. So you drop the level here. This is still kind of an all-time high. Well, it's not an all-time high, but it's still very high levels historically. But the bottom part's gone now. So we're also seeing credit card balances go up and credit card delinquencies going up. So all of this goes to what's likely to happen to earnings, right? Now, bank earnings are expected to be 26% lower than they were the previous quarter. But a big part of it is because they're putting money aside for loan losses. The third point of that loan losses point is that likely means their balance sheets are going to be in much better shape than 2008. Much better shape because they're putting this money aside now. And I said a second ago, they've been doing this since 2022. This is 2022. What I meant to say is they've been doing this since the first quarter of 2022. They've been building up those loan losses. They went from 1.4 to 4.5. It's estimated at 5.3 for the third quarter. It's estimated at 6.1 for the fourth quarter. So those are rising, and that's going to pull from earnings. But if we don't get massive loan losses, that means the recession that I do believe is coming won't be that bad.
Okay, yeah, I was just going to ask this with this new paradigm with at the banks. Will these earnings numbers, how does that put pressure on the stock index futures in the short term? I'm talking July, August, September.
I think, so people have been asking me what's the catalyst for the bottom in the stock market. I think it may be this earnings season. I think the worst thing that can happen for the stock market is that everybody jumps over a lowered bar, and we get a strong rally through earnings season that doesn't get up above, say, that 200 that you've got on there, right? Or maybe breaks above it on the ES, or we could look at the NASDAQ. That might be a better indicator of it, because you're not likely to see dramatic beats in tech stocks unless they've lowered the balance sheet, right? So if you see what's the level of the 200 moving average there, that yellow line, I can't quite see it on your chart.
It's 14,353.
Okay, so I could easily see earnings, people, companies jumping over a lowered bar, right? So the estimates are low. They jump over that lowered bar, and then we go from there. People think, okay, the bear market is over. But if we don't, first of all, a technical bear market is not over until new all-time highs. And if you guys remember, those new all-time highs in the NASDAQ specifically are way above 16,000, right? So that's a big move. But if we have pretty strong earnings versus analyst expectations, and we jump above that sort of 14,000 level that you just told me about, a 14.4, whatever it is, and we don't close above there solidly, people are going to think that's the bottom. It's not likely the bottom at that point. Because if we have stronger earnings like this, there's going to be a whole bunch of factors that are going to kind of keep us out of that technical recession in the short term. For me, the best thing is if we had a poor earnings season, we make new lows, I would then come out and say that I've turned bullish and that's the bottom.
Very interesting. That's awesome information. And we got a couple minutes left. Can I pivot really fast to the longer end of the yield curve? I got a 10-year note. I could put a 30-year treasury bond here. And what's always relatively a mystery to me is when you have these like 23% retracements that go back up in the middle of this heated CPI Fed interest rate battle.
Mm-hmm. I'm pretty encouraged by the lower yield here on the 30 because, well, really on the 10s out to the 30s. You can leave the 10s up. That's fine. But if you look at how we've kind of rebounded toward the lower end on yields, I think I had marked, no, I know I had marked, I'd marked the 10-year last at 305, and on the yield perspective, it's sitting about 293 again. And the 30-year, I think I had up to 315, and it's about 312 again. That tells you that the bond traders at least believe two things, one of two things. Either a recession is coming, period, nothing you can do about it, and that's going to slow inflation, or the Fed's actions are going to slow inflation. So the bond market at least believes from 10 years on out, you can go as low as 7 years, that inflation is going to be under control at that point. So that kind of boosts the narrative that the longer term deflationary aspect of, say, technology as a whole, as a productivity driver, is still in place. And we're just in a supply side, inflation driven, commodity driven cycle. I'm not sure I believe that because of some of the things I said. Health insurance is number one. Services inflation is much more sticky because it involves things where the price hikes aren't quite given back. We can use health insurance as one. We could use your dentist as another. We can use your landscaper. We can use the dry cleaner. The people who actually do things that they don't have a lot of physical input costs. Obviously, a dry cleaner does, but it's still mostly labor. They're not going to drop their prices generally. They just don't drop as fast as gas prices drop.
It's interesting. I live in kind of a destination city. You know, a lot of folks come to Charleston for vacations, for the beaches, for the historic, stuff. It's a beautiful place. And still today, restaurants, hard to get reservations, roads, beaches, stores, jam-packed with people. And I know I'm a little bit biased because where I live, but I mean, people are out spending money. And I really get the sense that the impact of COVID is such that people, we don't want to stay in we don't want to be sequestered anymore. We want to roam about the cabin and spend money.
You're spot on. And that's, I said this 6-8 months ago, revenge travel is real. I'm in Naples, Florida, same thing. Okay, one of the things I noticed the difference between this year and 2 years ago, the amount of garbage cans out on pickup day, right? Whereas last year at this time, it was like mine and 2 others. This year, our entire block is full, which means either people are renting their houses out or they stayed, right? I think revenge travel is a very real thing, but it will cycle down. When it cycles down, I don't know, probably come winter, right? But people were cooped up for 2 years. I'm hoping people, this is just my personal feeling, it's not an economic opinion or a strategist opinion. I hope people understand how cool and important traveling around and having these experiences are after being cooped up for that 18 months of COVID and being, just staring at screens and all this stuff. It's just so much better to interact. And if that's the case, economy will be supported. But right now, the economy is really supported by that narrative you just described. It's a big part of what we're seeing in these inflation figures.
Yeah, no, for sure. And I could talk to you all day long on this stuff. It's totally fascinating. We have a lot of comments too in the chat saying thank you for doing this for us, by the way.
I love it.
And also, yeah, and I want to give people an opportunity to find you, right? So what's the best way? Path Trading Partners is one. You have your podcast with Jimmy, which I love, Twitter, all that stuff. What's the best way to find you?
So the best way to hit me directly is on Twitter because I leave my direct messages open, or you can just tweet at me, and that's at Bob_Iaccino, which is IACCINO. I think it shows up on the screen here. Yeah. The other way is you could email me directly at support@Path Trading Partners. And I really hope you guys check out that podcast because we have some really big name guests on that thing. It's the Futures Edge podcast. It's on the free Spotify. You don't have to pay for the Spotify subscription. You just do the free one, and it's on there. And we also put it up on Path Trading Partners YouTube channel, where my partner, Mike Arnold, does a bunch of technical analysis 2 and 3 times a day live, which is where I learned a lot of what I do is from him. So I'd appreciate you guys subscribing to that if you get a chance.
Awesome. That's great. And hopefully everybody does. I do want to just mention one. Andrew Morris, who's a friend of the show, types in, is a former boxer. I'm guessing Bobby did some boxing. I could just tell.
8 years. Hey, tell Andrew, I don't know if you can hear me. God didn't give me this nose. Nikki Bellcaster gave it to me.
Nikki Bellcaster.
Gloves. I had the headgear on. He's still broken. God, that guy could hit.
Yeah, but he can't trade like you can. So no, he's out.
Anyway,
folks, I appreciate everybody being here. Bobby, appreciate your time today. I do want to remind everybody, please be safe out there. Be good to each other. Thanks for coming.